Home sweet home, but can I save on my taxes? Plus, that target date fund in your employer-sponsored plan that you have at work may not be exactly what you think it is. Welcome to our program this morning, Dollars and Cents, where we help you make sense out of all of those different decisions that have anything to do with your dollars. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a cost-effective and successful financial plan that can provide you with peace of mind for the future. Coming to you on Sunday mornings on air on the WFLA Orlando Network and 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web with over, last count, closing in on 12,000 downloads of our program. So if you don't catch us live this morning here on Sunday, you can always catch us on the internet. So before we get to home sweet home and those target date funds topics that we talked about at the start of the program, we wanted to take a moment and talk a little bit about what real active investment management means. There seems to be sort of a growing trend out there that uses the term of active management when in fact it's really not active management, and what it is at its very core is going to surprise you. So let's start by explaining what active investment management is all about. So if you've got an actively managed portfolio, there should be somebody or a team of somebody's, preferably, that is ultimately looking at companies on an individual basis. After all, when we own an investment portfolio, at the heart of it, if we've got any portion on the equity or stock side of things, is going to be individual companies. I think that's one of those concepts that people sort of forget as they think more globally or broad-based that, oh, I've got an investment portfolio and that is just what it is. Well, but understand, if you drill down, what it is that you own is really individual companies. And so if you've got an actively managed portfolio, then there should be a team of people involved in the decisions as to which companies do you actually own inside that portfolio. So a lot of different ways to kind of make those decisions, but you would expect them to obviously be looking at a company's financials. You would be expecting them to be interviewing top brass at that company. You might even expect them to look at what their competitors are doing and where they fit in the competitive landscape for that particular industry. And then you maybe want to be talking to their customers, to their suppliers, and kind of see exactly what is going on with that company before you actually make that decision to invest in that company. And then going forward, you need to keep re-asking those same kinds of questions. Has the financials changed? Has the industry changed? Has the competition gotten a better edge than this particular company? That, after all, is what active portfolio management is all about. It's looking at the companies, it's looking at the financials, it's having those conversations with top brass, having the conversations with customers, with suppliers, all of those kinds of things that go into making that decision, and then reaffirming those conversations along the way. And then if the answers to those questions change, well, then part of being an actively managed portfolio is then that particular company is no longer a part of your portfolio. The team of professionals that is making those decisions as to which companies to own, they then make a decision to not own that company, and then that gets sold. And ultimately, that's what active management and the heart of active management is all about. Here's what active management is not. And let's be very, very clear on this distinction, because it seems to be a concept or a distinction that folks are drawing more and more, particularly in the current environment where, let's face it, with COVID, there's a lot of fear, there's a lot of concern, there's a lot of unknown about what the future may hold. And oh yeah, don't forget, it's a presidential election year. The reality is that we're hearing more and more of an approach that is described as active management when the reality is it really isn't. So here's how the approach goes as it's been described to us by folks that have been using that approach and are now looking for different options. And the approach goes something like this: I'm going to get your investments out of the market when it goes down a certain percent, and then we'll get them back in the market at a certain level. That type of an approach where you're in the market, you've got an investment portfolio that hopefully should be well diversified across different companies, across different sectors of the economy, and then the pitch is that we're going to be able to get you out of the market at certain times and then get you back in. If it goes below an X percent, then we'll shift you out, and then we will attempt to shift you back in. The shifting back in is always kind of the murky side of the equation, because it's easy to determine, okay, I'm down 10% and I move out. But much harder issue on any of this is, when do you get back in? Here's the real kicker. If somebody says they're going to get you out at a certain level and then get you back in at a different level, that's not active management. What that is nothing more than timing. That service is basically a timing service. That's not active management. Folks, here's the point. Don't confuse active management. Active management has to deal with deciding which companies to own inside your investment portfolio. It has nothing to do with getting in and getting out. Getting in, getting out, that's a timing service. And here's the problem. Timing the market does not work. There's been way too many studies that prove exactly that the best way to significantly hurt your rate of return over time, to underperform, is in fact following some kind of a timing strategy where you're in, you're out, you're hot, you're cold. Don't confuse the two. You can put lipstick on a pig, but it's still a pig. You can call it active management, but at the core, it is timing. And let's be very clear on this. Been there, done that. 30 odd years ago, we had a company called Nelson Investment Timing Service. We get into stocks at this point in time. We get out of stocks. We go into bonds. We go into cash. We did it for 2 years. And if my father-in-law was still with us, he would say, at the end of 2 years, we realized that we were generating nothing of a return for our clients. So we returned them their money and we returned them the fees that we had generated based upon that experiment that we did for 2 years. Been there, done that. Timing does not work. And don't confuse active management. Be very careful with this. Someone's going to talk to you about I actively manage. We get in, we get out. No. Anything that's getting you in or out of the market is not active management. Don't put lipstick on the pig. It's still a pig. Anything that gets you in and out of the market is timing. There's no other way for it. It is timing. And folks, studies after studies, our own personal experience as a business in this financial services industry, we've been doing it since 1984. When my father-in-law started the company back in 1984, timing is timing, active management is active management. Don't confuse the two, because with one, timing, you get substantially lower returns over time than what you should have been doing. So note that distinction. Make sure you're aware of it when it comes to your portfolio. Don't let somebody tell you that they're actively managing the portfolio when all that's happening there is a computer program that triggers a bunch of sell orders when the market hits a certain level. That's a timing service. With that, we will take a break, and when we come back from the break, we're going to continue on with a conversation about target date funds. If you're a regular listener, you know we talk about this from time to time. We've got some interesting numbers to share with you on the latest. So we'll be back here on Dollars and Cents after these messages. So if you're a regular listener to the program, you know we're not particularly big fans of these target date funds. We often refer to them as pretty cookie cutter options that are basically sweeping through pretty much every employer sponsored retirement plan these days, whether it's 401ks, 403bs, 457s, it's target date fund, target date fund, target date fund, and not a whole lot of other choices. And we've got some numbers based upon some information that a long-term client of ours supplied about their particular plan that we wanted to share with you, because we think that there's got to be an awful lot of parallels out there in the workforce as a whole. So welcome back to Dollars and Cents, where we help you make sense out of all of those different decisions in life that have anything to do with your dollars. Coming to you here Sunday mornings on the WFLA Orlando network, also on 96.9 The Game. Also, we happen to be one of the top 25 financial planning podcasts on the World Wide Web. And of course, you can check out our podcast on any of the social media channels. Just simply go to our website, nelsonfinancialplanning.com. And then from there, upper right-hand corner, you'll see perhaps one of your favorite social media icons there, and then be able to connect directly to our podcast channel. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help provide you with a successful financial plan that provides you with peace of mind for the future. So there's a lot of reasons why we don't really like these target date funds, and we've certainly spent time on prior episodes talking about them. To just kind of recap their pervasiveness throughout 401ks, 403bs, 457s, basically employer-sponsored retirement plans, is just incredible how much of a sea change there has been in the typical investment options that employees get within their retirement plans that are sponsored by their employer. The typical, hey, we'll withhold from your paycheck and put money into this particular retirement plan for you. And the biggest couple of reasons why we don't like them is, number one, if you look at sort of the history of why these target date funds were created in the first place, they really were intended to limit liability for the employer. But by giving choices that are that cookie cutter, with a target date, with sort of a specific label as, hey, look at this date. This is the date that should match when you plan to retire. And that approach, because that's provided to the employee, really kind of absolves the employer of any liability associated with the investment choices or the investment choices that the employee picks. So understand that where these all started from was a desire by employers to limit their liability as it relates to providing investment options to employees. So stop right there. When was the last time that if someone's looking to limit their liability, that it turned out better for the other person? It doesn't. It doesn't work that way. When you seek to limit liability, you basically wind up providing options that are options, but beyond that, nothing really else. The other thing that troubles us on these target date funds is that you really don't know exactly what the composition is. You just pick it based upon a number. You match your date of birth with the target date of the particular fund, and that's the extent of the investment analysis. Just solely what year was I born, and that's going to just magically match up to the best possible investment option for me. Well, the problem with that is that there's much more to it than meets the eye, and the reality is that a lot of these funds have different allocations, and in fact, again, because of the concept of trying to limit liability, they go more conservatively in terms of the investment mix at a much faster or much sooner pace than you would expect. A typical target date type of fund that you would see would be perhaps a 2035 target date fund. Well, these days, those funds can have anywhere from 30 to 40% on the bond side. Well, if you're thinking you're still 15 years away from retirement, I don't know that I would go to a 30 to 40% bond positioning at this stage in the game. That's certainly a position that you might want to have if you are retired and seeking to be a little bit more conservative, a little bit more on the growth and income side of things, but certainly not if you're 15 years out. It's 2020, you're using a 2035. There shouldn't be a 30, 35, 40% bond component in there, but in fact, a lot of them do steer that way much easier. And we've got some numbers that really sort of underline exactly what that means. And they happen to, as we mentioned, a longtime client of ours shared them with us just this past week. And they are this is from a major local healthcare provider. We'll just leave it at that. It's a corporate retirement plan. And it underscores the other disturbing trend, which is that with the advent of these target date funds, the choices that you have besides these target date funds are pretty limited. This is a perfect example. So in this particular corporate plan, there was a total of, let me just do the math, 16 different funds. 9 of the 16 funds were target date funds. So over half were target date options. The others were 4 different equity funds. So basically you had just like 4 stock funds to pick from, 2 bond funds, a stable value fund, and a balanced fund. So out of the 16 choices, basically individualized, there were only 4 stock funds in which to pick from. That's really just shocking how few the choices are. So that's all fine, but let's take a look at perhaps what is the most important thing to look at when it comes to investments and when it comes to what the mix should be, and that is performance. So for that, I'm going to look at the sheet. Here's the crazy thing. If you look at all the different funds, so there's 9 different target date funds, right? So there was like a current one, a 2025, a 2030, a 2035, 2040, 2045, 2050, 2055, and 2060. Okay, so if you look at the 2045, the 2050, the 2055, and the 2060, those 4 funds that were like the funds that were way out, those had performance numbers over the past 5 years that were virtually identical. I'll give you the performance numbers. The 2045, 7.28, 2050, 7.31, 2055, 7.31, 2060, 7.32. You got 4 different funds that are supposedly invested over a 20-year time frame that is going to help give diversification to the workforce by simply matching up their date of birth with the particular target date fund. And there is no difference in the performance numbers, not just over the past 3 months or past year, but that's the annualized return that we just rattled off over the course of the past 5 years. 4 different target date funds covering a 20-year time horizon on the target date, and the difference in the 5-year performance numbers was less than 0.04 of a basis point, 0.04 for those that like the exact math difference on an annualized basis over the past 5 years. Folks, that's the same fund. There's no difference there. That's an immaterial difference. And if you go out even more, 2040, 2035, so now you've got 30 years of target date options, the difference of the 5-year number on the 2035, 6.94 versus 7.32. Boys, folks, when we say that these are cookie cutter funds, they are just that. You have 4 different funds covering 20 years where the difference in the 5-year annualized number is 0.04. If you expand it out even further and include 30 years, the difference between the fund that was the closest in was the 6.94 versus 7.32. That is a difference of less than 0.40% per year for 5. That's the same fund. Meanwhile, if you take a look at the 2060 fund, the fund that is furthest out, 7.32 on a 5-year number. You know what the market's done over that same period of time? It's done almost 11%. Stop and think about that. We're going to take a break. When we come back, we're going to wrap up this conversation about target date funds here on the program when we get back on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. Talking a little bit about target date funds on the program this morning, and not particularly big fans of them simply because they were created more to shield employers from liability, to sort of dumb down the process, if you will, in terms of what employees had to pick from, and more importantly, really thin out the available options. Welcome back to Dollars and Cents here on News Radio WFLA Orlando 96.9 The Game. Our program Dollars and Cents is a program that's been on since 1984, and it is Central Florida's longest running radio program. Heard live every Sunday morning on 96.9 The Game, WFLA Orlando. My name is Joel Garris of Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. So, giving you some of those numbers, right? So, if you look at that suite of target date funds, and this just happens to look at one of the largest health employers in Central Florida, and they happen to be using one of the largest investment management companies and one of the biggest providers of target date funds. If you look at those 4 different target date funds that cover a 20-year period of time, if you go from the 2045, 2050, 2055, 2065, so funds that should be sort of that more growth-oriented, those 4 funds have identical performance over the course of the past 5 years. Folks, that's the very definition of cookie cutter. You think you're getting something different, and you're really not at all getting that. So as with any investment, you've got to look at the performance numbers. You've got to kind of drill down and look at that to help guide you on that. Because what's even more disturbing when you start to do that drill down is not that the performance of these 4 funds that are supposed to like span a 20-year period are in fact not the same, or they are the same. The other part of it is just how poorly they perform versus the overall market. So that same employer provided platform, that same employer retirement plan had just a general old regular 500 index fund. And over the past 5 years, that's done close to 11%. So if I've got 11%, and meanwhile all these silly target date funds are coming in, the best one was 7.32. That was 2060. So again, if you're picking 2060, you should be having a growth, and your retirement's a long time away. But if the performance is less than 2/3 of what you would have gotten just kind of owning just a general regular index fund, then that really underscores the notion that don't opt in for the target date. Take a moment and look at the other choices, because those other choices are going to get you better performance over time versus those cookie cutter choices that are all the same. Stop and look at these numbers. If there's that big of a difference in performance over a 5-year period of time, then that equates to a 20% difference over 5 years. So if you've got $100,000 in your employer-sponsored plan, that could have been $120,000 if you steer clear of these target date funds and instead have owned just the broad-based market. So understand just how cookie cutter and plain vanilla these target date choices are. They generate the same performance regardless of which year you pick, particularly in the further out years, and they're nowhere near what you would have gotten had you invested in the broad-based market. And the point of them is that they're supposed to help match up an employee with the particular time frame, and the reality is they really don't. Because an employee that is planning to retire in 2060 might as well just own the S&P 500 index choice or similar in your plan. So what do you need to do? Well, tomorrow when you go into the office, well, actually that doesn't really happen as much as it used to with COVID, but when you look at your investment allocation, I suppose you could even do that this afternoon, even though it's Sunday. Make sure that you're not stuck in these target date funds. Take the time to really look at the other investment choices that are available within your employer plan. If you're far out from retirement, you really should be looking at the more market-based, large company oriented or even smaller mid-sized company oriented fund choices that are available in the plan, and steer clear of these target date funds because you're not going to get the return because they don't operate the way that you think you do. And you need to look no further than the numbers on it to see that. So make sure you take a look at that. Take the time to look at that. If you're using a financial advisor, they should be more than happy to take a look at the investment options that you have available to you in your employer-sponsored plan and help you with those choices. And they should do it at no cost. If they charge you for it, you may want to go elsewhere on it because there's no reason why they should be charging you for it. That is advice that should be part of a value add of their services. So take a look at that. That's a little homework to do. Nobody likes to do homework on the weekend, but you know what? That's some good homework to do that will help you plan better for your retirement. So speaking of COVID and kind of the pandemic and the fact that a lot of folks aren't perhaps maybe going into the office on Monday anymore, they're just rolling out of bed and going into another room in their house. Perhaps you're thinking, well, here I am, I'm at home, and what exactly are the tax breaks that I get for my home, particularly if I'm thinking about, oh, I need to maybe change some things up, maybe do an expansion or create a home office, or ultimately maybe I'm just looking at the interest rates and saying, okay, I'm going to refinance, or you just want to get out of the house and so you're thinking about maybe getting an RV or a boat or what have you. And as you may recall, there were a tremendous amount of changes that happened in 2017 as it relates to taxes, as it relates to the deduction of mortgage interest, as it relates to the deduction of home offices. And so we thought it would be good to recap some of those, because some of them do exist, and then others that do still exist in sort of limited capacity. So let's talk sort of broad base, because certainly there's a lot of people out there that are looking at the combination of low interest rates and too much time at home, looking to get out. Maybe they want to renovate, maybe they want to add a home office, maybe they just want to hop in an RV or a boat. And if you talk to anybody in the RV or boat industry these days, they are overwhelmed with demand as people are looking for options and alternatives to be able to do things rather than just stay at home. So certainly in 2017, there was a lot of tax changes. The biggest had to deal with the standard deduction. When the standard deduction jumped up from where it was all the way up to $28,400 for a married couple, that meant that a lot less people were able to write off their mortgage interest. And so the impact of that was that in 2017, there was a total of 33 million taxpayers who were able to write off mortgage interest. In 2018, that number fell to 13 million. Now, there wasn't 20 million people that all of a sudden paid off their mortgage between 2017 and 2018. What happened there is that higher standard deduction that made it difficult to get over the threshold, if you will, of being able to itemize your deductions. Another big tax change that happened in 2017 was it limited the interest deduction that you could take on a home equity line. And then it also repealed some of the tax benefits of having a home office if you were an employee, meaning a regular W-2 employee working for an employer. So those are the big tax changes that happen. The reality is, of course, you still can get your mortgage interest as a deduction. So if you're planning on purchasing a home or even that boat or that RV, that can be treated as a second home. But the amount of mortgage debt and the interest that, on the amount of mortgage debt, that's the part that is limited. So new mortgages after December 15th, 2017, limited to being able to deduct the interest on a combined total of $750,000 of mortgage debt on up to 2 homes. So if you've got a primary residence and a vacation home, or you've got a primary residence and a boat or an RV, understand though, remember the rules with boats and RVs, you've got to have a place to sleep, a place to eat, and a place to do your business in order to qualify that for a second home. So after December 15, 2017, limited to a total of $750,000 of mortgage debt and the interest that you could write off on that. Another big change in 2017 had to deal with refinancing and what you had to do with those proceeds to the extent you got cash out. So we're going to take a break. When we come back, we're going to tackle that topic in terms of cash out refinancings and what you have to do in order to justify the tax deduction. Coming up next here on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. Welcome back to the program. Home sweet home, right? We all are spending a lot more time at home these days as a result of the pandemic. And so a lot of folks are asking questions about, well, what's the deal with being able to write off my home mortgage these days? And is that still an option? And we talked in the prior segment about some of the big changes that happened in 2017, specifically much higher standard deductions, which meant that less people could qualify to be above that new higher standard deduction threshold. So a lot more folks found that their mortgage interest wound up, they could still write it off, but it didn't make a difference to do that because they were better off just taking the standard deduction anyway. And so the rules relating to your mortgage interest and being able to write that off still very much present, but there's definitely some tweaks. We were talking about one before the break about how you are limited to, it can only be a combined $750,000 of mortgage debt that you can write off the mortgage interest on. As an aside, hopefully you're not saddled with $750,000 of mortgage debt, but that's a different conversation for a different show, or shall we say, certainly a topic we've talked about in the past. Anyway, one of the biggest things that's happening, of course, is with low rates, improved real estate values. Many people are thinking about doing a cash out refinance. Well, here's the thing. Make sure that you know what the new tax rules on that are, because they are different. So if you do a cash out refinance, only the portion of that cash that you got that wound up going back into the house to improve it is in fact deductible. So if you do a refinance, get cash out, get cash in your pocket, you may find that you're not able to actually write off the interest on that portion that you wind up using that cash out for other things like paying off debt or student loans or consolidating other things. That portion, if it's not used to improve the house, you will not be able to use that as a write-off. Similarly, if you wanted to buy an RV or a boat or something like that, which is very popular, very high demand on those types of things, you can certainly deduct that. Again, it's got to have cooking, sleeping, and bathroom facilities on it in order to be able to count as a second home. You can certainly write the interest off on that. again, subject to that higher standard deduction. So if your mortgage interest doesn't add up to being greater than the standard deduction, then you're going to go with the standard deduction because it's going to be a bigger deduction. So just know that, though, that total amount that you owe has got to be less than $750,000. Obviously a big number, but certainly something to think about if you're thinking about buying a second home. So the other thing that changed was the ability of being able to write off interest on home equity loans as well. So what if you're getting a home equity loan and I mean, you're not looking to refinance your current mortgage, maybe it's already at a pretty low rate, or you just don't want to go through the costs of that full refinance. If you got a home equity line prior to 2017, up to $100,000 of that home equity line, you could use that money for anything and everything and be able to write that interest off. The rules obviously post 2017 have changed, and you are only able to write the interest off on a home equity loan if, again, you use that money to improve the house. See, a lot of these changes that were done in 2017 were designed to make sure that mortgage debt, refinancing, home equity lines, anything associated with your home, in order to be able to write the interest off, it had to actually really be associated with your home, meaning that you had to take the money and put it into the home in order to justify the tax deduction on it. So the rules certainly have gotten much more restrictive. Speaking of the rules that have gotten much more restrictive, that is the deduction of being able to write off your home office. So many folks obviously these days are finding that they're working from home. The flexibility to write off those expenses has been virtually eliminated when it comes to regular employees, W-2 employees that are working for an employer. Previously, you had the category called unreimbursed employee expenses that you were able to write off on your item as part of your itemized deductions. The reality is that that deduction was completely eliminated. So you don't get to write that off like you used to. Now, if you're self-employed, you can still do that, because if you're self-employed, you're reporting on Schedule C, separate schedule from Schedule A, which is itemized deductions. So you still can have that home office, that the percentage of your overall home, the ability to write that off on your tax return. But remember, here's the rule on the home office: that space has got to be used regularly and exclusively for business. So understand that there's some rules that you've got to make sure that you're following in order to justify that home office expense. And then lastly, remember that COVID exception. You can take up to $100,000 out of your IRA and with no penalty, and be able to pay the taxes back over a 3-year period of time. Maybe able to use that if you're thinking about buying a house or a second home. We're going to wrap it up and get on out of here. Thanks for listening to the program Dollars and Cents. This has been Joel Garris of Nelson Financial Planning News Radio, WFLA. Bye-bye.